Founders have adapted to 2026, but many funders still invest like it is 1970. The result is a growing gap between capital and innovation that leaves billions of dollars sitting unused. This is not because startups are unready, it is because the investment structures that control capital have not evolved with the market. The irony is that venture capital was built to fund innovation, yet rarely innovates itself. Traditional funds demand fast exits, strict control, and immediate returns, while startups need long-term stability, flexibility, and milestone-driven growth. The real challenge is not about risk appetite, it is about alignment and structure. When timeframes, expectations, and governance collide, promising ventures lose momentum. The solution is a modern funding model that protects investors, empowers founders, and lets capital flow efficiently into companies built for sustainable value, not short-term speculation or forced liquidity cycles. The biggest problem in startup funding today is that investors and founders live on completely different timelines. Venture capital funds target 10 times multiple of invested capital within 3 to 5 years to meet distributions to paid-in capital and internal rate of return targets. This creates constant pressure for early exits, aggressive control, and governance that slows companies down. Startups grow through milestones, not arbitrary exit clocks, and they rely on predictable runway, flexible capital, and strategic autonomy. Meanwhile, family offices, angels, and institutions that prefer patient capital want lower risk and structured returns, but they are excluded because traditional VC frameworks cannot accommodate their requirements. As a result, high-quality founders are underfunded, and cautious investors stay sidelined. Aligning these two worlds means redefining the funding relationship, so both sides operate on structures that allow growth, protection, and performance without sacrificing independence or compliance. Control and governance disputes are one of the main reasons startup partnerships fail. Founders want to move quickly, make creative decisions, and maintain flexibility in how they execute their vision. Investors, on the other hand, want oversight to safeguard capital, enforce accountability, and protect against loss. This leads to restrictive terms, protective provisions, and multiple board seats that slow progress and create unnecessary friction. Decisions that once took hours can drag on for weeks, morale drops, and trust erodes. Venture funds believe oversight equals safety, but too much control often backfires, reducing both growth and return. The ideal model balances transparency with autonomy, giving investors information and protection while letting founders lead operations. When structure replaces interference, both sides win. Governance should provide clarity, not control. Valuation is where most negotiations break down. Founders focus on long-term vision, customer traction, and product strength, while investors concentrate on short-term internal rate of return performance and multiple of invested capital benchmarks. They argue about pre-money and post-money valuations, liquidation preferences, and anti-dilution protections until momentum is lost. Down rounds turn cooperation into conflict, and trust disappears. The key to solving this is separating funding from equity until results justify valuation. Founders can receive milestone-based funding that does not require early dilution, while investors retain conversion rights at fair market value once performance is proven. This approach allows each side to focus on execution instead of endless pricing debates. Investors gain measurable protection, founders gain flexibility, and valuations finally become a reflection of actual growth rather than projections or guesswork. Alignment replaces anxiety, and the relationship stays. Exit strategy remains one of the most misunderstood aspects of venture finance. Founders build companies to last, while investors work within fund life cycles that require liquidity in 3 to 5 years to meet distributions to paid-in capital targets. That pressure leads to early sales, rushed initial public offerings, or strategic exits before true market maturity. It can also distort operational choices, with teams focusing on short-term optics instead of long-term value. Growth becomes driven by deadlines rather than strategy. The VC risk swap eliminates exit pressure by giving investors security and founders time. Instead of chasing liquidity events, companies can grow sustainably, reinvest in operations, and create higher eventual valuations. Investors still achieve their goals through structured returns and optional conversion, but without forcing early exits. The outcome is stronger companies, better returns, and relationships based on shared value creation, not conflicting timelines. A massive pool of capital remains on the sidelines because traditional venture structures do not meet investor needs. Family offices, institutional investors, and high-income professionals want exposure to innovation, but they cannot justify the risk profile or complexity that comes with it. These investors prefer steady returns, principal protection, and clear documentation. They want predictable income with the option to participate in upside later without being trapped by governance obligations or liquidity deadlines. Traditional venture capital leaves them out entirely. The VC risk swap solves this by combining insurance protection with investment potential, offering a model that provides safety, compliance, and flexibility. It allows patient capital to flow into innovation without the volatility of equity rounds or the rigidity of debt. For the first time, investors can participate in growth stage ventures with downside protection, making innovation a rational, structured, and scalable investment choice. Startups face the same structural exclusion as investors, just from the opposite side. Many early-stage companies are commercially ready, but cannot secure fair funding terms. Banks will not lend because of limited collateral, and venture capital demands valuations that are unrealistic for their stage. This forces founders into repeated rounds, constant fundraising, and early dilution that weakens long-term ownership. It creates instability and drains focus from growth. These founders need predictable multi-year funding tied to milestones rather than speculation. The VC risk swap gives them that path by offering 5 years of runway certainty, milestone-based funding tranches, and no governance interference. Founders retain control, and investors receive protection through contractual guarantees. The structure turns financing from a gamble into a process, allowing teams to build value without trading equity too soon. It restores balance between innovation, capital, and sustainability. The missing link between investors and founders is a structure that connects insurance, tax, and investment logic in one compliant model. Founders need predictable, multi-year capital that provides growth stability without forcing dilution or external control. Investors need principal protection, cash-efficient treatment, and fair market value conversion options that do not expose them to total loss. The VC risk swap delivers all these features. It offers insured revenue guarantees for startups and investment-backed protection for funders. It removes board seats, exit deadlines, and control conflicts entirely. Both sides gain measurable certainty and long-term alignment under accounting standards recognized by ASPE and IFRS. This is not speculation, it is structural modernization that integrates protection with performance. For the first time, venture funding can combine security and flexibility, turning innovation into an investable, scalable, and compliant opportunity for all participants. This market gap persists because the financial system has not evolved with modern business realities. Venture capital was designed in an era of quick exits, not sustainable development. Funds are rewarded for short-term distributions to paid-in capital and internal rate of return compression, forcing liquidity before real value matures. Regulatory frameworks still recognize only debt or equity, leaving no clear category for hybrid instruments. Insurance products were historically built for estate planning, not commercial use, so integration never occurred. Advisors often operate in silos, unable to combine legal, financial, and regulatory perspectives into one structure. The result is a funding ecosystem that punishes innovation instead of enabling it. The VC risk swap corrects this by creating a compliant, documented pathway that merges protection, capital efficiency, and growth. It is a financial architecture designed for today's innovation economy, not yesterday's risk equations. The VC risk swap introduces a structural innovation that bridges the worlds of investment and insurance. Instead of investing directly for equity, the funder provides a revenue guarantee to the company, which purchases an insurance policy as a business asset. This creates a protected capital flow where the investor's contribution is insured and the startup's operations are funded sustainably. Tranches are released over 5 years, ensuring discipline and milestone accountability. After completion, investors may convert at fair market value through an independently verified process. The structure eliminates dilution, forced exits, and governance disputes, while ensuring compliance under ASPE and IFRS. It brings patient, risk-averse capital into the innovation sector safely, turning venture financing into a professional, sustainable discipline instead of a high-stakes gamble. The VC risk swap transforms how founders grow and how investors protect their returns. Billions of dollars in available capital remain unused, while thousands of startups continue to struggle with poor terms, valuation tension, and unnecessary governance. The VC risk swap provides the bridge both sides have been waiting for. It replaces speculative equity with insured revenue certainty, allowing investors to deploy capital efficiently while protecting their principal. Founders retain ownership, control, and operational freedom, while funders gain transparency, compliance, and measurable returns. It eliminates valuation conflict, exit pressure, and dilution risk in one structure that satisfies both business and regulatory requirements. Whether you manage patient capital or lead a growing company, this model lets you build with confidence and align incentives for sustainable success. The VC risk swap is not a theory. It is the evolution of venture funding for the next generation. Three.